The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Hello and welcome to the latest episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager here at Serving Those Who Serve and Lee Sipe Associates, and actually the founder of Serving Those Who Serve. I want to begin, as I always do, by saying thank you. Thank you for taking the time to join us today. But above all, thank you for your service to the government, to the country, to me, to everyone. In normal times, you don't hear that enough. The last 18 months or so have been anything but normal. So you're definitely not hearing it enough, but you will always hear it here. The other thing you'll always hear is my buddy, the guru, Ed Zerndorfer. He's back once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Once again, we follow Ed's Fed Zone articles. You can find those at fed-zone.com. He's writing those every single week. This gives us one more way to reach and teach because some people like to listen or watch, and we can do that. But because he's written those articles, know this, your notes are already pre-taken for you. So you don't have to worry about scribbling on the metro or while you're driving or that type. So today we are talking about, boy, in my opinion, one of the most important and one of the most emotional and one of the most misunderstood decisions a retiring federal employee has to make, and that's planning for survivor benefits. This is about making sure the people you love are taken care of after you're gone. Ed's put together a thorough guide on survivor annuity choices the federal employees have and the consequences that come with each one. So, okay, Ed, let's start with the basics. If a federal employee is married when they retire, what does the law require them to provide for the spouse? And what happens if they want to do anything less than the maximum?
When a federal retiree, it makes a difference whether they're covered by CSRS or a CSRS employee, a CSRS Offset employee, a FERS employee, any type of employee. If that employee is married and they retire from federal service, they are required by law to give their spouse the maximum, it's called spousal survivor annuity. For CSRS, what is that maximum? It's 55% of what the CSRS retiree, what their gross annuity was at the time of his or her death. If they're a FERS employee, FERS retiree, maximum spousal FERS survivor annuity is 50% of what the deceased FERS retiree was at the time of their death. That's maximum. If they want to give their spouse anything else, and for CSRS, they have a wide number of choices. For a FERS employee, the other choice is less than maximum, 25% of what they were receiving at the time of death, or zero. Any other choice. The spouse has to consent in writing that they're waiving the maximum survivor benefit. What I'm saying, Dan, is that you can't do anything behind your spouse's back.
Good.
And it's important that way. Okay? So
I agree.
That's what the law says. Also, now there are some exceptions in terms of giving the spouse the maximum. One of which is that if there's a court order, and we'll get into that. We will get into that a little bit later.
Okay. I'd imagine there are forms involved. So you mentioned CSRS and FERS. So I'm guessing they're different forms, and I know you are the form master. So what are they?
As I say, when it comes to the tax business, there's a form for anything. In the case here, a retiring CSRS or CSRS Offset employee retires, has to fill out, this is the application form for retirement, it's standard form SF 2801. That's the application. And part of that application is how much you want to give your spouse as a survivor annuity. For FERS, it's standard form SF 3107. 3107.
Gotcha. So let's zero in a little bit on FERS, because our CSRS folks, we love you dearly, but there's actually more FERS folks that end up watching these things. So a retiring employee has a few choices as to the amount of that spousal annuity. You just touched on it. So let's walk through that with a little more detail through those options for that FERS employee, and importantly, how each one affects the retiree's own monthly annuity.
Yes, and I want to say from the offset, it's a great deal. It's a tremendous deal, as I'm going to say. And I just want to mention, like a plus for our webinars, we have a webinar entitled Understanding Federal Survivor Benefits. It is recorded, and you can listen to it at your leisure. It's now recorded. It should be, it was just recorded a few weeks ago, but it'll be available, I guess, soon. For listening, it runs about 3 hours. You listen to it like the podcast, turn it on, listen to it a few hours, come back to it later on. It goes through all the details about survivor benefits. And there are examples that I'll understand. Okay. So under FERS, the maximum spousal survivor annuity benefit is 50%. And in order to pay for this 50% spousal FERS survivor annuity, the annuitants, this is the FERS retiree, his or her annuity is going to be reduced by 10%. 10% of what? 10% of the starting FERS gross annuity. And I think it helps, Dan, if I do an example. I'm going to do an example. Let's say we have a FERS employee, married, retires, and their starting FERS annuity is $40,000 a year. And they're going to give their spouse the maximum spousal survivor annuity, 50%. So they're going to take a 10% reduction. 10% of $40,000 is $4,000. So what is the FERS annuitant's net annuity? $36,000. Now let's say, Dan, the worst thing happens, that the FERS annuitant dies within the first year of retirement. What does their surviving spouse get? 50% of $40,000, not $36,000. They get 50% of the gross. Now, let's be a little more optimistic, though. The FERS annuitant is not going to die within the first year of retirement. Let's say they retired at age 62. 20 years later, they're 82. At that point, they die. They've been getting cost of living adjustments in most years. So when this FERS employee retired, their starting FERS annuity was $40,000, but with 20 years worth of COLAs, it's gone up to $50,000. And that's when they die at age 82. It's $50,000. Before they die, what was their net annuity? Remember, they still have to pay for that survivor annuity. $50,000 less $4,000.
$4,000. Yep.
Which nets them $46,000.
Yep.
Then they die. What does the surviving spouse get? 50% of $50,000. What a deal!
It is. And Ed, the one point that I always bring up to people is that 10% is a reduction, not a deduction. So it's happening before tax. So it feels, right, lives, and spends like something smaller than the 10.
Best deal in town. It's the best deal in town. That's what I say.
I agree. Huge bias. I'm revealing it right now. Okay. Now
so that's one.
Yep. Go ahead.
So the other option for the retiring FERS employee to give his or her spouse something is the less the maximum, and that's 25%. Here's how that works. The FERS employee will take, the FERS annuitant will take a reduction of 5% of their annuity, starting gross annuity, and their surviving spouse will get 25% of their gross annuity at the time of death. So let's do an example. FERS employee retires, let's say, also has a starting FERS gross annuity of $40,000. They want to give their spouse less than maximum survivor benefit. So 5% of $40,000 is $2,000. So the FERS, when the FERS employee retires, their net annuity is going to be $40,000 less $2,000, which is $38,000. They die within the first year of retirement. The surviving spouse gets 25% of $40,000, which is $10,000.
Gotcha.
That doesn't happen. 20 years later, that employee dies, the original $40,000 goes up to $50,000 with all the COLAs, but their annuity is being reduced by how much to give their spouse of $25,000? $2,000. Their net annuity, $40,000 less $2,000, which is $48,000. So when they die at that point, their surviving spouse gets 25% of $50,000, which I think is $12,500. Great deal. Great deal.
Again,
Okay?
yes.
And then with their spouse's written consent, they can give their spouse nothing. It's called a life-only annuity. Nothing. Nothing. The spouse has to consent to that.
Don't like it.
Now, I get this question so often. My spouse, has a good retirement, himself or herself. They work in private industry, a lot of money in a 401k. They got IRAs. They really don't need a survivor annuity. And the question I ask the person is your spouse on your federal employee health insurance? Oh, yeah. Oh, yeah. Well, guess what? If you don't give your spouse a survivor annuity, then as long as you're living, they can stay in your federal employee health insurance. And in retirement, you realize the government's paying the same percentage of the premium of your FEHB premiums as you were an employee, namely 25 to 28%. Yeah, I have self plus one coverage, myself and wife. They're going to pay 25 to 28% of premiums. If you don't give your spouse a survivor annuity, then upon your death in retirement, your spouse is going to lose that benefit. They're not going to be able to. They're not going to be able to retain the FEHB coverage because you don't give them any portion of a survivor annuity. Oh, I didn't know that. Okay. How about 25%? Would that do it? Yeah. Got to be a little careful though. Will the 25% be enough to pay all the premiums for the FEHB? Yeah, sometimes it depends on the size of the annuity, but you got to give them something.
Sure.
And then another person says to me, "Oh, but my spouse, in addition to having a great retirement, works for a private company. They have a tremendous 401k plan. They got matching, and they also have health insurance. My spouse has health insurance through an employer." Asked the person, has your spouse asked your employer about what happens when they retire in terms of their health insurance? Have you asked? No, boy, my spouse assumed that they'll give in retirement because they have to. What do you mean they have to? They have more than 50 full-time employees. Have you heard about the Affordable Care Act? I said, I heard about the Affordable Care Act. Yes, I have. I'm really familiar with it. The Affordable Care Act says the following: if you are an employer and you have more than 50 full-time employees, you have to give your employees health insurance. The permanent employees, you have to give them health insurance. If you don't, you pay a fine. But the Affordable Care Act says absolutely nothing. What happens when those full-time employees leave their employer or retire? They're on their own. I had a situation with a lawyer, works for a law firm, and she has health insurance. She had health insurance with the law firm, and the law firm pays all the premiums. It's a great deal. Well, guess what happened when she turned 65? She gets a letter from the benefits department. Oh, we note that you're turning 65. You're eligible to enroll in Medicare. You're off our health insurance. They dropped her, and they can, because the Affordable Care Act says if you have access to other insurance, like Medicare, the employer does not have to retain you on the health insurance. And she found out what the cost of Medicare supplement, Medigap plans are. She was shocked because she needs to have a Medicare plans.
Sure.
So this is a reason that you have to give some amount of a survivor annuity to your spouse.
Absolutely. Now, your article also goes beyond standard spousal choices, and there are some special situations. So let's start with the insurable interest annuity. Who's that for and how does it work?
Yes, an employee can give what's called, when they retire, give an insurable interest survivor annuity. Now, who's considered to be what is an insurable interest? An insurable interest, this is for an employee's insurable interest, is an individual who, in relationship to the employee, is closer in relationship than a first cousin. Who would that include? A child, a son or daughter, a sibling, a brother or sister. It could include a parent, a dependent parent, okay? But there's some problems with this insurable interest. First of all, if you're married, you want to give it to an adult child. Your spouse, again, has to give written consent for that to happen. You cannot give it to a child without your spouse's written consent, without consent, okay? And also, the FERS employee, in order to give let's say they're single. They're not married. Wants to give this insurable interest survivor annuity to someone else. The employee has to be healthy. They have to go through a health exam. In other words, OPM does not want, the government does not want someone to give an insurable interest survivor annuity because they're going to die soon.
Sure.
I also want to point out that the calculations for the insurable interest survivor annuity are different than for a spouse.
Oh, yeah.
Okay. And I say that because going back to our examples of the spouses, let's take the maximum, the 50% to 50% survivor annuity benefit. When I talked about what the cost is, 10% of the starting FERS gross annuity, or 5% of the starting FERS gross annuity. But, I didn't say anything concerning the age difference between the retiring employee and the spouse. They could be the same age, Dan. One spouse could be older, much older, 5 years, 10 years, much younger, makes no difference. It's that same time. But with the insurable interest, in the insurable interest survivor annuity, the age difference comes into play. The bigger the age difference between the retiring employee and the insurable interest, the larger is going to be the cost. So the best way to explain it is through an example. Let's suppose we have a federal employee who's retiring at the age of 62. She's a widow.
Mm-hmm.
And she has a child who's 32 years old, a 30-year age difference. So her starting FERS annuity is $30,000, is $40,000. There is a 30-year age difference between she and her daughter, who she wants to give a survivor annuity to. And OPM has tables to this. The bigger the age difference. The more reduction to the annuity.
Sure.
With a more than 30-year age, with a 30 or more year age difference, the reduction is going to be 40%. 40%.
Ouch.
But now we're going to see the difference. So the retiring FERS employee starting FERS annuity is $40,000. You want to give it to the survivor annuity to her daughter, 32 years old. So the reduction in the annuity is going to be 40% of what?
$40,000.
$40,000. Now what is the net annuity? $40,000 less $16,000. 40% of $40,000 makes $24,000. So the FERS annuitant dies. So what is her daughter going to get? 55% of $24,000. They get 55% of the net, not the gross. Now, Dan, I tell you, for the life of me, I don't know why would somebody want to give it to a child. People say to me, well, they want to give the child something. I say the question, did your parents give you something like that? I highly doubt it.
Absolutely.
Then they say, will they be able to get FEHB insurance because they're getting a survivor annuity? No, only a spouse.
Yep.
So it doesn't make sense to me. So
I agree. What about former spouses, Ed? You know, a lot of our listeners have been through divorce. How do court orders and divorce settlements factor into this?
Yeah. Well, if I say that you've been married, if a FERS employee has been married to someone while in federal service for a minimum 9 months and they divorce, 9 months, they got to be married, and they divorce, and there's nothing in the divorce settlement that says that the former spouse is to receive anything, that does not mean the former spouse cannot, later on and apply, go to a lawyer, the divorce lawyer or family law attorney, and to come up with a court order to demand the survivor annuity from their former spouse. Now, obviously, if they're married just 9 months, they can't get much of a survivor annuity. But it's possible. And if let's say they were married longer and they're entitled to get a much larger annuity, but their former spouse has moved on, they're still in federal service, remarried, and the former spouse is demanding a full survivor annuity. And that's what the settlement is. That would mean that this FERS employee's current spouse will get nothing in terms of survivor annuity. That's how it works. So now, it can happen that the former spouse will lose rights to a survivor annuity. How so? They remarry. before age 55 and they were married to the former spouse for less than 30 years. If they remarry after 55, they won't lose it. So there are the ways around it. Again, we talk about this during our survivor benefits webinar that individuals can listen to.
Yep. Here's one that surprises people. What if a federal retiree gets married after they retire? Can they still provide a survivor annuity for the new spouse?
Yeah, and I got to tell you, this podcast is very, very timely because yesterday I got a phone call for a postal service retiree. He worked under the old system, CSRS, and the same rules. And he told me that he got married 3 years ago to a woman who's 20 years younger than him, 20 years younger. And he wanted to know if he could give her a survivor annuity. And let me just give you the rules. Before I give my answer, let me just tell you what the rules are. Okay, and this applies both to CSRS and FERS. If a FERS annuitant gets married in retirement and has been married for at least 9 months, the annuitant at that point, they got to be married for 9 months, at least 9 months. At that point, the FERS annuitant can apply for a reduced annuity in order to give their now spouse a survivor annuity. They have to wait 9 months. They have to make sure they're married at least 9 months before they can do that. Now, keep in mind, same as if this FERS annuitant, when they retire, they make that election to give a survivor annuity to their spouse and take a reduction. At this point, OPM has to figure out how much of a reduction will be in their annuity in order to give this new spouse a survivor annuity. There's going to be a reduction. Either the full amount of 50% to get the 50% annuity, or the less than maximum 25%. It's going to be a reduction. And actually, there's going to be two reductions. There are going to be two reductions. The standard 10%. And then the other reduction is due to the fact that there's been a time gap between the time that the FERS employee retired and now they got married in retirement.
Sure.
And OPM was not collecting the survivor annuity. So essentially, it's a deposit, it's interest charges. And it's pretty hefty. So in a way, it's a penalty, but I can tell you that there may be reasons why this employee decided now they got married, they want to give a survivor annuity for spouse. Health insurance, to retain the FEHB,
Sure.
Okay? Maybe they want to make sure their spouse is well taken care of, taken care of in retirement. So
Sure.
that might be a reason.
Absolutely. Now, Ed, decisions that made in retirement can feel permanent, but in your article, you point out there is a window to change a FERS survivor annuity election. What are the time limits and what changes are actually allowed?
Yes. A FERS annuitant may request in writing, they got to do this in writing, they have to send writing to OPM's retirement office, to change their current spouse survivor annuity election made at retirement no later than 18 months after they retired. They got a limit. After 18 months, they cannot change what they're giving their spouses, what they're giving their spouses in terms of the amount of the annuity. I want to say this when I say change. They only can increase what they're giving their spouse. They cannot decrease. If they decided not to give their spouse anything, when we said that life-only annuity at retirement, then they got to change their heart. That wasn't a good idea. They found out, if I don't give my spouse any amount of annuity, then they're going to lose the FEHB. I better give them annuity. Well, they got 18 months from the time they retired to make that election. Okay. So again, what they're going to be changing is they can make the following changes. A FERS annuitant may change their new election not to provide a survivor annuity to their spouse at the time the FERS annuitant retired. Or a FERS annuitant may increase the election of less than maximum for 25%. They can elect now to give 50%. But again, they're the only two options they have. They cannot reduce the amount of the annuity.
Now let's shift to something everyone should be doing, regardless of their situation, and that is beneficiary forms. Why is it so important to keep those up to date?
It's estate planning 101. You can have the greatest estate plan, available, but one of the, if you're missing designation of filling out all your beneficiary forms, you're missing a part of your estate plan. It's so important because you want to make sure that your assets upon your death go to loved ones as rapidly and as least costly as possible. And the answer is through a beneficiary form. Anything you can name a beneficiary form, any type of asset you can name a beneficiary form, you have to do it. And you have to make sure the beneficiary forms are up to date. So let's go through the list of beneficiary forms all federal employees should fill out. Okay? Standard Form 3102, SF 3102, designation of beneficiary form for the federal employees retirement system. And what is that for? When you're a FERS employee, you're contributing a part of your paycheck every 2 weeks into the FERS Retirement and Disability Fund. Those are contributions that are coming from your paycheck that you get back as part of your monthly annuity. Now, if you die before you get all those contributions back, sometime during retirement, any leftover contributions you made to the FERS Retirement and Disability Fund will be paid to a named beneficiary via this form, SF 3102. Analogous to 3102 is the designation of beneficiary form for the civil service retirement system. That will apply to CSRS employees and service officer employee. That is Standard Form 2808, SF 2808. All the forms I'm mentioning now, with the exception of the TSP form, can be found at www.opm.gov/forms. Next form, Standard Form SF 2823, designation of beneficiary for the Federal Employees Group Life Insurance Program, SF 2823. If you have private individual life insurance policies, make sure you have a beneficiary form filled out for your life insurance, so your private individual life insurance. Makes no difference, term, permanent life insurance, have a beneficiary form filled out. Okay? TSP, big one, TSP-3, designation beneficiary form for the thrift savings plan. Now, that benefit, the TSP beneficiary form TSP-3 has to be filled out online. You can't download a form and fill it out on paper. You have to do it online. And to do that, you have to have an online account with the TSP. Okay. I'm going to, and any individual can be the beneficiary of the TSP. A spouse, adult child, adult sibling, a travel organization can be named as beneficiary on all these beneficiary forms. And I want to add some other beneficiary forms that many people don't think about. If you have bank accounts, you have a bank account, your checking accounts, savings accounts, CDs, you have savings bonds, U.S. savings bonds, standard form, POD, payable on death form, POD form should be filled out and make sure it's up to date. And again, anybody can be designated as beneficiary of your bank accounts and savings bonds. If you have a brokerage account, I know, Dan, you're associated with a brokerage. It's called a TOD form, transfer on death. And what is the purpose of these beneficiary forms? By filling out these beneficiary forms, you will, upon your death, it will accelerate the passing on of your assets. No probate, nothing, no bureaucracy here. It goes to your loved ones and your designated beneficiaries as rapidly and at no cost to your loved ones.
Yep.
You want to do that.
No, absolutely. Important stuff, folks. And this is exactly the type of tip and planning that spares the family a world of stress at a difficult time. So getting those elections in, do it. When in doubt, fill it out. Ed, as always, I don't know how you keep all this straight, but thank you for doing it, and thank you for doing it with us.
My pleasure.
Well, folks, that's a wrap. We are Serving Those Who Serve. Be sure to subscribe to this podcast on our YouTube channel and Spotify, and remember to share it with your friends and a few strangers. Check us out in our live webinars every single week. Head to the SWS website, swserve.com. You'll see the webinar button. Click it. That will open up the full menu. Sign up for one, sign up for all. The guru comes to you. Reach you where you are, teach you where you are, and above all, serve you where you are. Share it with your friends. I promise you they'll thank you. Be sure to read Ed every single week in the Fed Zone. We covered 2 of them. There's at least 2 more every single week, and they're all great stuff. You can find that at fed-zone.com. So signing off, as I always do, for Ed, for Serving Those Who Serve, and me, Dan Sipe. Good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.